Hey everyone, it is 10:24 on Wednesday morning and wanted to give you an update as the markets are trading. I wanted to wait to see how the first couple of hours of action went this morning off of the after the report that came out on Thursday, right? So we had Friday, which led to a long weekend, then we had Tuesday, and we've had a couple hours to trade today. So we're starting to digest the data that the USDA gave us. And the first chart I want to show you is this chart here of soybean meal. This is March meal, and you can see we've had this explosive move higher. And what has caused that is really the drought in Argentina. So they're the world's largest exporter of soybean meal, and with the drought, this market got really excited and exuberant, and that has drug soybeans up with it. Now, remember what's coming in soybeans, which is the massive crop in Brazil. So what we're looking for is some sort of weakness in here to spill over into soybeans. Now, what I want to show you on this chart, and this is just a good educational piece, divergence. We've talked about divergence a lot. To us, it's one of the most important technical indicators, and the reason that we keep these lower indicators on our charts, and they should jump out at you like this. This is absolutely textbook. You have a massive run up with big strength in volume and price action, which are these two indicators. So you see the indicator make a high along with price. Then you have a pullback, and that pullback brings these indicators back below their zero lines. Now you have a new high in price with the indicators failing to go with it. So what we have here in meal is a situation where the funds have gone to an all-time long position, but the last move up, there hasn't been a whole lot of excitement or exuberance or new buying coming into this. That's what that's telling you. And so this divergence is striking. And now we could push a little bit higher. It doesn't matter. That divergence is going to keep getting bigger, and I think it's going to keep getting sold by algorithms. And if you see this day here today reverse and come all the way back down to yesterday's open, then I think that's really going to be strong evidence that the top is in here in meal, and that's going to spill over into beans. Now, the reason that we're not excited about chasing beans at the levels that they are, even though they're up, is because of this divergence and because of the supply coming in South America. So here's what beans are doing today. So that we made a new high overnight, and we've reversed so far today. The selling has really picked up and accelerated here in the last hour, and because right at 8:30 we tried to rally it. So I think knock on wood, I think beans are topping here, and a topping process can be pretty ugly and it can be pretty choppy. But if it does top here and accelerates lower, then I think beans are in real trouble off of these counts, and these lower targets down at 12 that we've been warning of are in place. What would drive that? Well, it's like we've been talking. Here's what the balance sheet looks like. This is what the USDA gave us. This is where we think we are going. Why did our balance sheet contract? Because they cut the yield. Really, that's it. The demand picture is not any better or worse than they had originally thought, even though they've shown a small cut here. But what we think is coming are lower prices because we have such a large crop coming out of South America. So, and I think that's why you're seeing new crop beans much weaker than old crop. So this is old crop. For those of you that are new to this, March is an old crop contract, which means we're really trading the supply that we just harvested, and the November contract is new crop, or the upcoming year. And it's much, much weaker. You can see we've had none of the strength relative to old crop. So that's telling us exactly, this is confirming to us exactly what we've been seeing in the balance sheets, which is we have weaker prices coming ahead, and I don't want to be chasing these old crop highs unless something comes to light that really changes our mind. So we're going to keep looking lower. Obviously, it closed today below 1528 or even 1512 would really bolster that argument. So it's too early to say, hey, yep, we've topped, we're going lower. But as of now, I think it's starting to become more and more likely. So we're just going to stand firm and hold our course. For those of you that are looking to hedge new crop beans, we had recommended a $15 call and a $13.40 put to give you some wiggle room against volatility. I know beans are hard to hold hedges on because they're expensive and they're volatile, but that gives you new crop upside momentum or upside movement to 15 and puts you at a 13.40 floor. If you wanted to spend a little bit more and put that right here at 1380, that's not a bad idea either. That position is still good. You can see this is breaking out the bottom of its wedge. The longer support holds, like this 1380 level, the longer it holds, the bigger the break that will come through it if it fails. And no different than the upside here. The longer it held, the steeper the break up above it. And so Jeff's giving me a note here. Yes, for those of you that are cash hedgers and don't have a trading account, if you wanted to do that $15 1340 strategy, you can call your elevator and ask for a min-max contract with a 1340 minimum and a $15 max, and see if they'll put that position on for you. Most will, some won't, but most will. And so if you take that position, I think you'd be happy with that, with at least a portion of your production. So that's what's happening with soybeans, and I hope that makes sense as to why we're not chasing this rally. Same with corn. Okay, so here's where corn is after yesterday's big exuberant day. The more we digest the numbers, the more bullish they should have been. And the fact that we are only up 40 cents off of those numbers, and the most we got was about a 20-cent reversal. The peak of this day was 73 to 49, so we were up about 24 cents. That probably should have been a 50-cent move. We probably should have blown this thing all the way up to 7. And the reason that we haven't is because the market's fairly skeptical, I think, of the USDA's numbers, and it's conscious of the fact that we may have already killed some demand. So there's not enough here either to say a top is in place, but this inflection point, which is the upward boundary of this corrective price channel, and this blue dotted line, which is the point from which this move started. We've got this inflection point right here at 692, and we've found some weakness right up against that here this morning. So we have been recommending owning 690 calls, and we were long 670 puts, right? And we were long 670 puts and feeling really good about that position. I'm glad we hedged them, but today the action that we're taking is we're selling futures against this 692 level. And we are holding the 690 calls. At some point today, I'll probably sell the 670 puts. I have not pulled the trigger on that yet. It just kind of depends how weak we get. But I like short futures, long calls against this point right here. I think that's a nice move, because even if we're wrong here, there's still a lot of resistance in here and plenty of time to get longer if we need. So if you just exit your futures at 692 and hold your calls, then we can just see what happens. But otherwise, we'll just keep selling the futures below it. And I think that's the right, as of now, as of 10:33 a.m., I think that's the position that we want to be in. Again, this is trading. I'm not saying that we're going to roll over and die here. I'm not saying we're going to blow higher. I just think that the best risk reward on this chart is short below this inflection point right here. And it's hard to get in and out of futures because you need you want a nice solid point to trade from that's not too far from current price, and we've had that here all morning, so I really like that. You can also see this downtrend line that is from this peak to this peak. It comes into play right where we are here at 682. So we broke above it yesterday. We're throwing back and testing it now, and if we break back through it, then that could really accelerate selling back lower. So another reason I like short futures here is because of the move we talked about yesterday on the weekly chart. So we talked about the importance of closing on top of the weekly cloud. That's such a big signal. It's worth it to us to fade it first, because if that signal does hit, then it triggers something significant and something that the market's probably not even really thinking about yet. And so I'm not saying that's not going to happen or can't happen, because we know that the odds are that there's a 60 to 70% chance here that that won't happen. But there is a chance that it could explode higher based on something we don't know. So to me, it makes sense, hey, fade the 70% first. And if you're wrong and it does blow higher, awesome. You got lots of room to make up for it on the upside. So we are cautiously pessimistic on corn at the moment. And if we reverse this thing and head lower, then to me, that really triggers a big sell signal coming into this formation. All right, now let's look at Kansas City wheat. Our stops on wheat yesterday did get hit at 850. This morning, they're pressuring that again. Again, that's this downtrend line starting from these highs right in here. And we have, so far, these have held. If this gives way and we trade back inside it again because beans and corn roll over, then I think wheat's got to go with it, and we're going to have to re-hedge them pretty darn quick. And I hate that, yesterday's low is really the low we should trade from. Unfortunately, yesterday was a huge day in Kansas City wheat, right? I mean, you got a range of 30 cents, so you just got to give it a lot of room here. But anything above 839 to us is probably still okay. Below that, that's where we want to be really nervous about hedging, re-hedging wheat. All right, I hope that's adding a little bit of clarity for you on how we're viewing it. Again, new crop stuff. Oh, here's new crop corn. I wanted to show you that. New crop corn, same thing as old crop. It's not as strong as old crop is. Remember, old crop took these highs out and is trading up in this area. New crop hasn't done it yet, and it's already given back up its trend line. And I think as I film this, so has old crop. Yep, it's starting to give it back too. So at the moment, I think we're looking lower across the board, but we'll keep you posted and let you know if anything meaningful changes in that from that perspective. All right, if you have questions, please call us or text us. Let us know what you're thinking, and we'd love to help you think through anything that you've got going. Remember, there is risk in trading commodity futures and options, and you should do so in light of your own financial condition. We will talk to you either later today or probably tomorrow. Have a great night. We'll talk to you later.